Hello class, this is Dr. Fenton. In these series of videos, I'm going to show you the highlights of each chapter. And this will be, of course, the chapters for our Accounting 201 course. So I'll go through the chapters page by page, not cover everything in the chapter, but I will cover the most important parts and the items that you really need to concentrate on. You still need to go back and read the chapters entirely yourself. So a good way to study for this material is to watch this video, listen to what I have to say, it'll help you understand the material, and then go back and read it word for word yourself. Not only read it word for word, but also look at each of the exhibits and illustrations they give you. Alright, so let's get started. Here in Chapter 1, we have Management, Accounting, and Corporate Governance. You can see the learning objectives we have in here. We'll talk about the managerial and financial accounting differences, first of all. And then we'll get into a little bit of cost accounting to talk about how they account for the production of items. So let's see. You can read this yourself. So let's go to the next page and see what we have. Now, in the first course, in other words, Accounting 200, you studied financial accounting. That was where we prepared the financial statements to present to people outside the company. So you remember the four financial statements we had in the first course. We had the income statement, the statement of stockholders' equity, the balance sheet, and the cash flow statement. Those were presented in a certain format. We had to follow a certain format, and they were presented to people outside the company, as I just said, to stockholders, to government organizations like the ACC and so forth. And so those were required to be prepared under what we call generally accepted accounting principles. So GAAP, GAAP. Now, in managerial accounting, as it says right here, the place I have highlighted, managerial accounting focuses on information used by executives, managers, and employees who work inside the business. And so there is no formal format of the reports that we must prepare for people inside the company. It's just whatever they need, we can prepare that information. So that's a big difference between financial accounting, where we must use GAAP to prepare the statements for people outside the company, and managerial accounting, where we can prepare any report we like, any way you want to, as long as it provides useful information to the decision makers within the company. Let's scroll down a little bit. And you can look at this. It says economic data, financial data, and non-financial data. And you can see who uses all this data. Investors and creditors, they're worried about the economic data of, let's say, the country or the world in total, and they also want to see the financial data of the corporation. Now, the senior executives inside the business, they're worried mainly about financial data, but also they do have their eye towards the economic data and some non-financial data for their own decision making. As you get within the company, middle managers, operating employees, they tend to use more non-financial data and less financial data. They need it to make quick decisions and decisions that are in the best interest of the company. We talked about this, GAAP and so forth, and the SEC oversees the accounting profession. We see here that managerial accounting uses more estimates. We're going to see this throughout this course. We will be using estimates. We'll have to allocate cost, based on our best decision-making ability, but we will be using a lot of estimates. And you can see here that financial accounting reports what happened yesterday. All the financial statements that we prepare, those are historic financial statements. Not history as in 1,000 years ago, but what was the month end, year end, quarter end, whatever. It was like historical data. It has ended. And then it says managerial accounting reports what is expected to happen tomorrow. So this is where we do get into estimates. We'll be estimating cost. We'll be estimating revenues. We'll do this to hopefully make good decisions for the company. Also, you can see that managerial accounting information is delivered on a continuous basis. Not just day by day, but hourly, minute by minute sometimes. We need to know what's happening, like in production, with the company or whatever, so we can instantly make a decision. And again, we need this information. These are not the basic financial statements. These are reports and various statements used within the company. And again, these can be prepared in any manner that provides useful information to the managers and employees of the company. Scroll down a little bit more. I'll let you read this yourself. Let's go to the next page. Now, the components of product cost. This is where we're really getting into what this course is all about. For a good number of chapters, we're going to be talking about production and production cost. And this chapter barely introduces this to us. Later chapters, we'll dig into it in a lot more depth. We have three main areas of cost in the production cycle. We have materials, we have labor, and we have overhead. Now, materials and labor, we're going to see as we go through several chapters, those are the two easiest areas to understand. What are the raw materials we are purchasing and using in the business, in the production line? Easy to account for. What about the labor? What workers, how much do we pay them for their production labor? That's fairly easy to account for. But overhead, we're going to see in a number of chapters, it's the most difficult area to really comprehend and understand and get exact cost for. But we're going to do our best. Don't worry about that. So overhead will be the utilities for the factory, the depreciation of the factory building, equipment. It can be the janitorial salaries, supplies we're using. A number of things goes into overhead. So think about the production facility out back, a big building where we're producing the product. All production cost except for, so think about this, all production cost except for labor and materials will be overhead. So we have three main areas: materials, labor, overhead. Well, if it's not a direct material and it's not direct labor, everything else falls into overhead. And we can call this manufacturing overhead. It means the same thing as just plain old overhead. Here's a quick little example, fairly simple here. We have a company that takes $1,000 in cash and then converts that into $390 for materials. That's what we paid for. We paid labor $470, and we had overhead and the tools. Again, there's a lot more overhead than this, but this is a simple example. So we took $1,000, converted that into materials, labor, and overhead, and we made 4 tables. So $1,000 in all these costs, materials, labor, and overhead, converted into 4 tables, the finished product. Now, how much is the average cost for each of these tables? Well, you can see this easily. If it cost us $1,000 to make 4 tables, it's $250 per table. That's the average cost. Okay. So again, a very simplified example, but you need to understand this. We are going to take financial resources. We are going to put that into the production area. We're going to buy materials. We're going to pay labor, and we're going to pay for a lot of different overhead items to make the finished product. And then what that will show you is that I'll go back up here. When we take this money, convert it into production, and make our units here, 4 tables. As of right now, before these are sold, these are inventory. You can call this finished goods inventory if you want to, but this money, $1,000, was converted into inventory. This sits on the balance sheet until you sell it. And so none of these costs here, none of the $1,000 in this example, has hit the income statement yet. It's not an expense, it's a cost. It's a cost that is capitalized as inventory and will sit in the inventory account until you sell it. So that's what it's explaining down through here. Some costs are inventory items, other costs can be expensed. And we saw that in the first course. You pay for, selling administrative cost, interest costs, taxes like in this case, front office salaries, all those are expensed and go straight to the income statement. In this course, we're going to see that we're going to spend a lot of money in production, and all that cost will be inventoried first and will not be expensed until we sell the inventory, and that's when it hits the income statement. So it goes on here with the example. If this company sells 3 tables, and we now take the cost of 3 tables, $750 total, we expense it. It goes to the income statement as cost of goods sold. This is a very important concept here, cost of goods sold. So remember that. You take cash, put it into production, materials, labor, overhead. You have the finished product as an inventory in your asset account. Then when you sell it, you move the cost out of the asset account into the income statement through the account called cost of goods sold right here. Okay. And it's what happens at the end. We took the money. We had $1,000 in finished goods inventory. We sold 3 of those tables. $750 goes to the income statement under cost of goods sold like an expense. The other $250, representing the table we did not sell, stays in our ending inventory account, the finished goods inventory account. Any selling and administrative costs that are not related to production, so they are not production costs, they go straight to the income statement. So all production costs go into inventory first, stay in inventory until we sell the inventory, and then the cost of that inventory that we sold goes to the income statement. Non-production costs go straight to the income statement. They don't stop in an inventory account. Next page. This is an example. They have 10 transactions. I'm not going to go through every one of these. You will see down here we have the accounting equation format. You saw this back in the first course. And so you should still remember that you have your assets on one side, the left side, then that's going to equal equity. And if we had liabilities in this example, which we don't, it'd also be on the right side here. So assets are always equal to liabilities plus equity. But in this example, we don't have liabilities. So we'll just forget about that part. Just 2 quick refresher entries, like the company acquired $15,000 cash by issuing stock. You increase the cash account. You increase the common stock account. Here's the equal sign. So this side of the equation equals this side of the equation. That'll always hold true for every transaction and the totals you would have after every transaction. The second one, if you paid $2,000 cash for materials to make products, cash goes down $2,000, but look, our inventory goes up $2,000. We do not take this $2,000 and put it over here as an expense. If we are buying materials that are going to be used for production, this is an inventory cost. It goes into an inventory account. So please read these in detail. I'll cover the last 2, but read the rest in detail. Follow the examples through here. But the last 2, we sold inventory to customers for $7,500 cash. You should know your cash account increases as well as our inventory account, revenue account increases. And since revenue increasing will have the effect of increasing net income, that also has the effect of eventually increasing retained earnings. So we'll go ahead and put the $7,500 here. Now the last one, the inventory we sold in event 9 here cost $4,000 to make. So what we'll do is take $4,000 out of inventory. This will be like the finished goods inventory account, and place that into cost of goods sold, which is an expense, which lowers net income, which then would have the effect of lowering retained earnings. And then you get your totals at the bottom here, and this is sort of like a balance sheet across here. And again, make sure you know that these 4 accounts here equals these 2. Don't try to add these in with the accounting equation. The accounting equation stops here, our equity. It doesn't get into income and expenses. So here's a quick income statement of the transactions you just went through. You have sales minus cost of goods sold, give us gross margin, sometimes called gross profit. Take away your selling, general, and administrative expenses to get net income. The 1,700 is the same thing we had right here. And the balance sheet is right here. These are all the numbers at the end of that accounting equation format statement we just looked at. And so nice, fairly simple balance sheet. Now overhead cost again, we'll talk about it a little bit more here. We're going to see it pop up chapter after chapter. Okay. Manufacturing overhead, like I said, will be all production cost except for materials and labor. Everything else. These are called indirect cost. This can include indirect materials, and these would be materials that we do use in production, but in general do not cost very much. It could be glue, it could be tape, it could be small nuts and bolts or whatever. But it is technically a material, but it's indirect material because it's not a major part of the product. Same way with indirect labor. It could be like supervisor salaries. The supervisors are not working on the production line to make the product. That would be direct labor. The supervisors are overseeing what's going on. They indirectly relate to production, so their salaries would go into overhead. So as I said before, there are a lot of costs that are going to go into manufacturing overhead. Here is a little example. If you read here, it says that, and this again is a very, very simple example to get us started. They look at 1 day of production. And so in 1 day, they spend $120 for utilities for that 1 day. They made 2 products. They made a chair, they made a table. Now, if it takes 2 hours to make a chair and 6 hours to make a table, there's the 8 hours for the day. So what we'll do is take the utilities cost of $120 for that 1 day, divide by 8 hours for the day, and then allocate it at the rate of $15 per labor hour. And so if the chair took 2 hours to make, we will allocate overhead costs to the chair. Again, this is not direct materials, not direct labor. This is overhead. We allocate $15 times 2 hours. $30 of the $120 goes to the chair. Let's apply some to the table. $15 per hour. It takes us 6 hours to make a table. So $90 goes to the table. That's attached as a cost to the table. So here's the $120 being split up. 30 goes to the chair, 90 to the table, and it makes sense. If the table takes more time to make, we should apply more overhead cost to that item, right, to the table. Okay. So we're going to be doing a lot of this in the next couple of chapters. So read down through here, and let's go to the next page, and just some definitions here for manufacturing companies. Upstream cost, and as you know when you're reading the textbook here, you can click this, and this gives the definition. So an upstream cost incurred before the beginning the manufacturing process, such as research and development cost. Those are upstream cost. Let's close it. Midstream costs are composed of costs incurred in the process of making products, including, and here we go, direct materials, direct labor, and manufacturing overhead. The 3 cost areas of production. That's a midstream cost. Downstream cost incurred after the manufacturing process is complete, such as delivery cost and sales commissions. Okay. And let's see, read through this yourself. So this would be good for you to read. And now just-in-time inventory. It has a good example here about a student selling flowers on campus. Please read through it. Just-in-time inventory system means that you don't acquire your inventory until right when you need it, just in time. You don't keep excess like raw materials on hand. You wait until maybe that morning. What do you need for production that day? And your supplier is so close that your supplier can deliver the inventory that you need for your production that same day. Maybe you contact them early in the morning, they get it to you within 1 or 2 hours. So this is a way to cut down on what we call carrying cost of inventory. You lose money if you have a lot of your cash tied up in inventory sitting around. So the just-in-time system is efficient. If everything runs correctly, you can save money. So this is a good example for you to see how Paula Elliott can buy flowers at one place. It's sort of far away. She has to use her car. She might run out of flowers. She might have some flowers left over she cannot sell, which is a waste. But then she finds another option close by, and her profits go up. So a good example to follow. Next page, corporate governance. Read through this yourself. This is an area for the last 20 years that has really taken off. These large corporations need more governance, since there were some bad frauds that happened about 20 years ago. And so, you have the accounting profession, you have the SEC, overlooking these corporations. They need to have good corporate bodies, like a board of directors, and they have management, and they have shareholders and auditors. And these people help determine how a company is operated. We need to make sure laws are followed, procedures are followed, and so forth. And this is all to help prevent fraud. Read through this. If you get down to here, you'll see that some companies, like I said in the past, have committed fraud, and that caused a lot of shareholders to lose a lot of money. Get down here, and here's the fraud triangle it talks about. So if there's opportunity, if there's pressure to commit fraud for various reasons, and then the person wanting or who commits fraud rationalizes it in their mind, that's how they committed it. They had all three of these together, the fraud triangle. They had opportunity, maybe access to the cash inventory. They felt pressure, like they needed the money or whatever, and they thought, well, stealing a little bit will not hurt. So they might steal a little bit at the beginning, then steal more, and so that's how a lot of fraud happens. So look at that, and let's see what else. And get into the appendix, and we're not going to worry about that. So, okay, and there's a self-study review problem that you can look at. So again, a quick review of Chapter 1. Go back and read it word for word, and like I always say, and number for number itself. Follow the examples through, and this should get you, hopefully, to the point that you understand Chapter 1 fairly well. So as always, good luck with your studies.